Among ladies and gentlemen, I'm Hiral Datia. We have with us Mr. Indranil Pan, Chief Economist at Yes Bank, joining in. Welcome to the show, Mr. Pan, and always a pleasure to speak to you and get insights from you. Clearly, let's start with, the actions of the RBI. Overall, if you go to see, as we know that the repo rate has been hiked by 50 basis points to 5.9%. Firstly, what's your take on it?
I think it's more or less it was anticipated by the market that it would be a 50 basis points. And the market gradually veered around from the fact that it was earlier anticipating a 35 and then it was anticipating a 50. Mainly, I think, due to the very fact that the inflation, last reading of inflation surprised on the higher side at 7%. And the aggressiveness shown by the rest of the world, especially the advanced economy, in terms of their monetary policy cycle, the RBI had to follow relatively closely to the global cycle. And I think it's pretty sort of specific and clear in the communication that the governor did with the market, not really in the policy, but the governor's statement. And he clearly sort of has put two paragraphs on exchange rates. And to a certain extent, it is also very clear that the thought process of the RBI is likely, even going forward, to relatively fight the storm than even only look at the domestic dimensions of growth and inflation.
Right. So with all of this said and done, Mr. Pan, clearly, if you see in terms of the rate hike, are they actually considering inflation to a great extent in terms of how to manage it?
Obviously, inflation is under consideration, no doubt. And given the fact that the currency is depreciating, what is really happening today is that US is exporting inflation to the rest of the world. So while US may be able to therefore contain the inflation pressures that are domestically ingrained to a certain extent, supply chain pressures are also to a certain extent coming off. It would be more difficult for the rest of the world to manage the inflation cycle because the inflation is today exported out of the US due to the monetary policy actions and due to how the currency markets are placed. So agreeing to that, and given the fact that RBI's own sort of research shows that a 5% depreciation in your currency leads to about a 20 basis points increase in the interest in the inflation, headline inflation. So that's clearly, the external world is clearly a focus today. The other factors that the RBI did point out is that, yes, the inflation in terms of its projection is relatively, they are sticking to the earlier projections and the trajectory both. But having said that, I think there are a lot more noises that have been raised in this policy in terms of the risks surrounding inflation, and that too from the food side. And the fears, therefore, that inflation in terms of its second round implications could be sort of become unhinged. And that's the space where the RBI wants to possibly come in and prevent any unhinging of the inflation expectations at this point in time.
Right. So overall, would it be right to say that, clearly the way the policy and the stance has come out in today's session, the central bank is holding back more cards than it has placed face up on the table, and the mere reason being the unpredictable nature of the global economy and the precarity of the growth inflation dynamic in the domestic economy?
I'm not sure about the sort of your question really deals with the forward trajectory of the policy, or you say that possibly in terms of the size of the increase, more should have been done. I don't think the size of the increase should have been more, because that to a certain extent would have created an even bigger nervousness in the market. And I think the RBI is clearly sort of, given the global atmosphere and given how it is affecting the global financial order and the negative implications of that on the emerging market, RBI definitely didn't want to shock the market. So I think 50 basis points is fair. And to that extent, the market also is satisfied that the RBI is not relatively more hawkish than what it had thought. In terms of the cycle and the extent to which this cycle will go, I think at least I am looking at the RBI now standing ready to deepen as well as sort of pull this cycle for a relatively a longer period of time. So at this point in time, compared to the previous policy, my expectation today is another 35 in December and another 25 in February. So the peak rate to me is now looking at around 650. But again, having said that, the dynamics of the global conditions are so fluid that nobody, including the RBI, would want to box themselves into a certain space and then being seen to do something else. And that's clearly the reason why the RBI has clearly gone against the any indication in terms of the forward guidance.
Right. So we're saying basically another 60 basis point rate hike in FY23 is what could be on the cards.
Yeah, that's fairly the point.
Right. And overall, if you see in terms of the inflation trajectory and the growth forecast as well, that the government has, that the RBI has come up with, what's the sense that you pick up? Because clearly, if you see in terms of the growth forecast for FY23, that has been reduced as well. Certainly, inflation has been retained at 6.7%. Are these numbers that you would be happy with, or do you think you would have a different viewpoint in terms of estimation?
No, even when the RBI had a 7.2%, we were at a 7% in terms of the growth. And after the first quarter numbers came out, we brought our growth target down marginally to a 6.9%. And we were anyways expecting that the RBI would bring their growth projection for the year down to a 7%, which has happened. Now, the whole point is that given the monetary policy cycle that is evolving, and given the fact that we now expect the monetary policy cycle to pull through all the way to February, which is the last policy for the year, the bigger implication of the tightening of the monetary policy is likely in the next financial year rather than the current financial year. Now, having said that, I'm not sure whether you have looked into this, but the monetary policy report that comes out, they have now projected the next financial year growth at 6.5% compared to the 7% this year. And more importantly, if you look through the sort of median forecast of the external sources, which also is taken as an input by the RBI, the median forecast of the external forecasters is actually at a 6.1%. And therefore, the point that I'm trying to make is that there is a bigger implication in terms of the current interest rate cycle and the current stacking up of the global monetary policy dynamics, the loss in the export market. And if you put all that together, the bigger implication is possibly in the next financial year rather than this financial year. And I think that is something that we need to keep in mind.
Right. And overall, if you see in terms of the way the FI and FDI is coming in right now, what's the sense that you pick up, especially on the forex side of it, the way the rupee has been moving? Dollar index again has started to cool off.
Well, I think the market is extremely dynamic. But if you really ask me, I don't think the INR comes below 80 once again. So we have sort of graduated ourselves to a new range. If not, the fears of 82 possibly, or an 83 that had built up over the last 7 to 10 days, that possibly is not there at this point in time. There is one incremental news also that has possibly cooled off the currency market today, which is basically saying that the RBI is possibly asking the state-owned banks to move their dollar sort of demand out of the market and look at the credit facilitation that they have. So that's another important dynamics. So overall, I think the RBI would be watching the currency markets. Seasonally, there is a positive seasonality that comes through in the fourth quarter when companies from abroad or subsidiaries owned by domestically held companies, they bring back their receivables. So services inflows are anyways on the higher side. So all that will come together for a relatively sort of stable and sideways momentum in terms of the rupee dollar. In terms of the FDI and the FPI, I think FPI remains a challenge. Because the interest differential between India and the rest of the world is pretty low at around 340 basis points compared to an historical average close to about 500, 550 basis points. FDI is a black box. But having said that, I think if we are projecting growth at 6.5% for the next year, FDI to a certain extent also is dependent on the absorptive capacity of the economy, which is definitely weakening.
Right. So moving from there on, if you see in terms of the current account deficit as well, around at $23.9 billion, that's 2.8% of the GDP is what we've seen in the first quarter of FY23. And it's widened from 1.5% of GDP that we saw in the fourth quarter of FY22. So how are you seeing that number? Because do you think it's a better than expected reading? How are you reading that number?
To a certain extent, it is better than expected, because what has really happened is that most of the number crunching that we do within the current account deficit, the exports and the import numbers generally are known. That is known by the from the Commerce Ministry release that comes on a regular monthly basis. But what we could not gauge properly was the services flows, and services flows actually has turned out to be relatively better than what the advanced data tended to show. So that's principally the reason why we got a relatively better CAD. Going forward, the second quarter for the CAD is likely to be the worst quarter for the CAD for the year, simply because that is also the period when the government had crunched down or clamped down on the exports of oil and also wheat, atta, and more recently the rice and some of those products. So that implication will be showing through, apart from the very fact that we are expecting the global growth to slow down, which also is likely to negatively have its implication for the exports, while to a certain extent there is a stickiness in terms of the import side picture, mostly the non-oil, non-gold imports. So given that, for the full year, we are now estimating a 3.8% CAD GDP ratio, and the balance of payments deficit to be around $50 billion.
Right. So at 3.8%, at what levels are we assuming crude to be at?
We are assuming crude at a 95.
Okay. And
while the RBI has assumed for most of its calculation, the RBI has assumed now crude at 100.
100, correct. So overall, then would it be right to say that there is a possibility that we could expect some pullback in the rupee once the Fed pauses its tightening cycle, probably most likely by the end of calendar year 22? Is there a possibility?
Well, it's a very dicey game in the sense that even if the Fed pauses, but you see the global economy actually slowing more sharply. I think so the point that I'm trying to make is that monetary policy divergence for a certain period of time was determining how the global currencies were moving and the implications of that on emerging market currencies. Today, I think we have slightly shifted out of that into saying that the risk aversion from an impending slowdown and a recessionary trend in most of the global world, that is likely to impact the currency market dynamics globally as well as emerging market. Now, let us not also forget that we have seen a relatively sharp depreciation of the CNY. So even as we continue to focus on the dollar and what is happening in the monetary policy space there, let's not lose focus on the CNY, because the implication for the CNY on the Indian currency is likely to be higher, given the sort of thread relationship that we have in the Asian region. So the Asian currencies would tend to depreciate faster if the CNY depreciates, and hence INR needs to depreciate. And that's also possibly one of the reasons, in my opinion, why the RBI let go of their sort of psychological level of 80 and moved it higher to a psychological level now of around an 81.50 or an 82. And that is possibly the level that they would be attempting to protect at this point in time.
Right. So with all of this said and done, my last question coming to you is with regards to where bond yields are concerned. Now, do you think there is a scope for a significant rally in the domestic 10-year yields, or do you think it's limited due to the compression that we are seeing in the domestic yield spread vis-a-vis the US bond yields to below 4% from an historical average of almost 5%?
I think the bond yields more or less should be where they are. In the sense that my sense is that the 10-year bond yield in India The domestic issues that would affect it is not really the RBI's policy cycle, but it is more to do with the fiscal. And given the fact that we are still not looking at over borrowing through the government securities market by the central government, I don't think we have a real scare on the bond yields at this point in time. And I would sort of cap it at around 7.50. Maybe we may have a 10 basis points outlier to that, but we will finally gravitate towards the central tendency of a 750, and we are more or less at around a 735 and a 740. To a certain extent, yes, the bond yields will be a function also of where the 10-year in the US is. And the US yields, when they had jumped to 4%, we also had seen a very significant reversal of the bond yields domestically. Now, my sense is that going forward, even as interest rate hikes in the US happen, the slowdown fears will probably prevent bond yields in the US to ramp up in a similar fashion. And that could be also a comforting factor for the domestic bond yields. So I would sort of at this point in time think that the bond yields are capped at around 750, 760.
Right. And very lastly, overall, if you have to compare India to any of the other economies, where would you place it? And do you think we do have much more a cushion than the others, and we are somewhere insulated?
Again, I think it's a very, very difficult question that you have asked, in the sense that what we see today is a very rapidly changing economic scenario globally as well as in India. The advantage for India on the growth side is that we are a domestic consumption-led economy, not as much as an export-led economy as in Indonesia or a Thailand. So that cushions us, no doubt, in terms of the growth side of the story. But having said that, we still have a significant reliance on oil and global commodities. So if global commodities were again to sort of move the other way, now they are on a softening bias. If it were to move the other way, or even if oil were to move the other way because of the politics that is around oil and the winter months approaching. So those could be some of the risks which may actually shake the confidence or the relative strength of the Indian economy could to a certain extent be shaken. My bigger fear is more towards the fiscal. While we seem to be celebrating on the fiscal given the higher tax collections, I think 90% general government debt as a proportion of GDP is high. And in this interest rate increasing cycle, that is likely to show up definitely in terms of the interest payment bill of the government. And to a certain extent, we will be limited in terms of the sort of build out trajectory to bring the fiscal down, and therefore create more scope for the government, both the center and the state, to push resources towards capital or infrastructure growth.
Right. So overall, a lot of things that we need to wait and watch as well, as to how things pan out globally to see an impact. But thank you, Mr. Pan, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you very much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.